Good day everyone, I am Alvin G. Villegas from DSBA-FM. And today, I will discuss about the chapter 10, which is the intermediate term financing. Intermediate term financing refers to borrowings with repayment schedules of more than 1 year but less than 10 years. And there are two types of term financing, which is the short term and the long term. The short term financing is repayment in less than 1 year, and the long term financing matures in 10 years or longer. So, the best examples of intermediate term financing is when a company is securing a term loan or to fund the expansion of its manufacturing facilities. These types of financial typically has a repayment period of 3 to 10 years, making it suitable for projects that required moderate funding over a medium-term horizon. So let's tackle about the advantages of intermediate term financing. First, expansion of assets provides an alternative when the firm can't expand assets with internal or short-term funds. Then, second, funding for small businesses. Source of funding for small businesses without easy access to capital markets, especially to those businesses that are newly started. And third, more convenient alternative. At times, it may be less costly and more convenient when raising funds through bonds or stocks in capital markets. Intermediate term financing can be a more convenient and cost-effective option compared to raising funds through bonds or stocks in capital markets. Then the last one, or the fourth one, is the tax advantages. Interest on terms loans is tax deductible, offering potential tax advantage compared to tax issues. Tax deductible, it means businesses can be deducted the interest expenses on the loan from taxable income, proving potential tax advantage. Then the last one is the cost efficiency, allows borrowing funds as needed, minimizing interest costs by paying only on the actual amount borrowed. The cost efficiency or borrowed funds as needed with intermediate term financing. So let's tackle about the term loans by private financial institutions. The intermediate term financing is provided by private commercial banks, finance companies, factors, insurance, and pre-need companies. Then term lending by private commercial banks. Private commercial banks, or PCBS, constitutes an easily identifiable source of term loans. The extensive network of branches of PBS provide easy access to intermediate term financings or credit. For examples, or there are some examples of bank branches spread over the Philippines are the Philippine National Bank, the Metropolitan Bank, and Trust Company. Then the term loan defined. A term loan is a bank advance for a specific period, normally 1 to 10 years, repaid with interest, usually by regular periodic payments, such as a monthly or quarterly. Borrowers are expected to make regular payments of a predetermined amount to gradually fulfill their payments obligations. So let's move on to the types of term loan. There are three types of term loans, which the first is the straight term loans, second is revolving credit, and the third one is the evergreen credit. So first, we're gonna tackle about is the straight term loan. Granted to finance fixed assets, fund permanent working capital needs, and temporarily replace liabilities incurred before obtaining truly long financing. Typically extends up to 10 years. Then, these structures assures both the borrowers and the lenders to be clear terms and timeline for repayment, offering a stable framework for managing the loan. Then the next one is the revolving credit, legally assured line of credit, usually extended for 2 or 3 years periods. Usage of funds, working capital requirements, offering flexibility and reduced interest costs. Credit lines range from 0 to a specified figure. Assurance ensures the borrower that money will be available when needed. Then commitment fee payment, which is borrowing pays commitment fee to unused portion of the credit. So let's tackle about the last one, which is the evergreen credit. Revolving credit arrangement without a stated maturity or does not have a fixed term within which it must be repaid, or instead it remains open indefinitely, allowing ongoing access to credit. Conversion options, which is creditor banks has the opportunity annually to convert the credit into a term loan, means that with an evergreen credit arrangements, the creditor bank has the options on a yearly basis or to transform the revolving credit facilities into a term loan. The conversion allows for a shift from the open-ended revolving credit structures to a more structured and defined term loan with a specific maturity date. Then the last one is the term loan maturity, determined by the economic life of the borrower's equipment. That are the types of term loans. And let us know the common provision of loans are the following. First, working capital maintenance. Purpose is ensuring a specified working capital or current ratio to maintain liquidity for loans repayment and cover firms' working capital needs. Second, financial statement submissions, which is requirements furnished and statements allows the creditors to access financial prospects to protect their interests. Then the third one is the property sales prohibitions, which is restrictions prohibited from selling or disposing business properties, excluding inventories and pleading assets or secures others' loans. Then the fourth one is the insurance coverage mandate. Requirements is to provide ample insurance coverage for business properties and case employees to better settle obligations in case of losses. And the next one is the dividend and salary restrictions. Restriction in cash dividends and a ceiling on office salaries to manage financial distribution and executive compensation. The next one is fixed assets compensations limitations, which is restriction to limit on expanding fixed assets behind the term of loans amount to prevent higher risk associated with expansions programs. And the next one is the debt list prohibitions, prohibited from incurring additional long-term debt or additional less obligation to maintain controlled financial structures. And the last one is the stocks purchase restriction, not allowed or prohibited on purchasing the company's own stocks to prevent certain financial transactions impacted the company's equity.
Hello everyone, I am Maria Jane Alarba and I am going to tackle the term lending by insurance company, finance company, and government. So the first one is the term lending by insurance companies. So it refers to the practice of insurance providers offering loans to individuals or businesses. So when we talk about term lending or loan, which means borrowing money under an agreement to pay it back later. So what is an insurance company? It is the financial institutions that sells insurance, just like for example, here's a Cebu. We have the Coco Life, Medicare Plus Incorporation, and so many to mention. They offer services providing financial protection from possible hazards in the future. And the types of insurance are the life, health, long-term disability, and auto insurance. So just like for example, the life insurance loan. So this one has a lower interest rates than a personal loan, and you can use the money for any purpose. Then on a nice case, you don't need to repay this loan before you die. But there are also downsides to consider, just like a loan balance will reduce the debt benefit. The second one is the term lending by finance companies. So it refers to the provisions of loans to individuals or businesses by finance companies, which are non-bank financial institutions that specialize in lending activities. So this one can on a fixed interest rate and schedule day that you need to repay. So a finance company such as the central banks, retail and commercial banks, credit unions, savings and loan associations, investment banks, and companies. So it is an organization that makes loans to individuals and businesses. Unlike sa bank, the finance company dili makareceive of cash deposits gikan sa clients, nor does it provide some other services common to banks such as checking accounts. So this one is a short-term loans offered to businesses for capital expenditure and expansion among others. So these loans are tailor-made to suit the various financial needs of businesses. So the last one is the term loans by the government. So this one, it refers to loans provided by government agencies or entitles to individuals, businesses, or other organizations. So just like sa term loan by finance company, this one also kay nanay fixed interest rate and schedule day that you need to repay. So there are types of government loans such as education loans, agricultural loans, business loans, housing loans, and veteran loans. So the government also other types of loans that fulfill specific needs such as disaster relief loans. The purposes of government term loans. So government loans can be used to stimulate economic growth and development by providing financing for businesses, infrastructure projects, or job creation initiatives. So government loans can also help individuals access education and training opportunities, promoting workforce development and skills enhancement. Government loans can provide financial assistance to small businesses, enabling them to start up, expand, or overcome financial challenges. Government loans can assist individuals and communities in recovering from natural disasters or unforeseen emergencies. And lastly, government loans can support the development of purchase of affordable housing units, addressing housing needs and promoting access to stable housing options.
Good day everyone, I'm Kenji Pitogo and I'm going to tackle about the summary of Chapter 10, the intermediate term financing. When we say intermediate term financing, it refers to borrowing with repayment schedules of more than 1 year but less than 10 years. And naa po diri ang short-term financing o long-term financing. When we say short-term financing, ang short-term financing kay has repayment schedules of not less than 1 year. And sa long-term financing pod, it matures in 10 years or longer. Sa intermediate term financing, na po siya yung mga sources. Ang mga sources niya is ang private commercial banks. Ang private commercial banks kay diri na bilong ang mga Citibank o PNB. And also the finance companies, mga factors insurance o ang pre-need firms. When we say pre-need firms, it is a local industry in the Philippines. And example nila kay like sila mobile sa tuition o mga memorial services. And also it was regulated by the SEC or the Security Exchange Commission. And then transfer into Insurance Commission. Sa intermediate term financing, napatay gitawag term loan. Ang term loan, mao siya ang loan nga gina-offer sa mga business para himuong capital or expansion sa business. And gihimo ni siya nga loan para suportaan ang mga financial needs sa business. Ang kaning term loan, kaya na siya 3 types, which is the straight term loan, revolving credit, o evergreen credit. When we say straight term loan, it is granted to finance fixed assets. When we say fixed assets, mao na siya ang fixed assets kay mao na siya ang gina-purchase nimo for long-term use. Like for example, the building, the land, o equipment. And ang limit pod aning straight term loan is 10 years. And ang ikaduha is revolving credit. Ang revolving credit, it is legally assured that the line of credit is normally extended to 2 to 3 years of time period. And also, it gives borrower flexibility and reduce interest costs. And ang last, ang ika-third is the evergreen credit. Ang evergreen credit, it is a revolving credit without maturity. So, when we say maturity, it is a final payment or due sa imong loan. Sa term loan pod, napod tayo upat ka repayment programs. Ang first is equal principal payments. Under this arrangement, kay ang loan daw dire is repaid in equal amount of principal. Sa ang ikaduha is equal amortization. Ang equal amortization kay ang loan dire is repaid in equal installments. Sa balloon payment pod, ang loan po dire kay ang equal pod equal installments, repaid equal installment. But mobayad kag dako if maabot na siya og maturity date or final payment. And ang last is deferred payment of principal with a grace period. Dire ang amount sa imong payment nimo sa principal kay kuan gipostpone or giput off, but magbayad gyapon ka sa interest. Sa intermediate term financing, kani nga type nga financing kay it is a useful source. Nani say advantage nga dili mo makita sa lain nga type of financing. Ang first niya advantage kay it is a source of fund sa mga small businesses. Like katong mga business nga walay access sa kapital. Ang second kay it may be less costly than raising a fund. Third is tax advantages. And fourth is it allows the firm to borrow a money or kinahanglan nila nga amount nga money para sa katong stage of financing. In addition, even the government offers loan. It is also the sources of intermediate term financing. Some example of this are the LBP or the Land Bank of the Philippines, the DBP or the Development Bank of the Philippines, and the GSIS or the Government Services Insurance System.
Everyone, I'm Rachel Faith Snowing from Group 4. The topic that I will discuss is about capital market, components of capital market, cost capital, and the securities offering in the capital market, the primary market, and the secondary market. Capital markets refers to the venues where funds are exchanged between suppliers and those who seek capital for their own use. They play a crucial role in the company by facilitating the trading of financial instruments such as stocks, bonds, and currencies. Capital markets are financial markets that bring buyers and sellers together to trade stocks. Capital market is where companies go to raise financial capital or money in general. Stock market is exclusively where investors trade stocks or shared ownership in public traded corporations. Longer-term loanable funds refers to funds or capital that are available for borrowing over an extended period of time. It refers to the money that can be lent or borrowed for longer durations, typically beyond 1 year. In the context of financial markets, longer-term loanable funds are often associated with loans or instruments that have longer maturities. These funds are typically used for financing large projects such as infrastructure development, real estate investments, or business expansion, which required a longer time to regenerate returns or pay the borrowed amount. So, there are three parts of capital market. First is the bond market, is where various debt instruments are sold by corporations and governments. Bonds are issued to raise debt capital to fund operations or seek growth opportunities. The bond market, also known as the fixed income market, is a segment of the financial market where bonds and other debt securities are bought and sold. Bonds are debt instruments issued by governments, municipalities, corporations, and other entities to raise capital. Bonds have a fixed maturity date, which is date when the principal amount is repaid to the bondholder. Second is the mortgage market. The mortgage market is a segment of the financial market that deals with loans secured by real estate properties. It specifically focuses on the lending and borrowing of funds for the purposes of purchasing of refinancing residential or commercial properties. The mortgage market is influenced by factors such as interest rates, housing markets conditions, and government policies. The last one is the stock market, a portion of the capital market where the common and preferred stocks issued by corporations are traded. It has two components, the organized exchange and the less formal over-the-counter markets. Stocks represents ownership in a company. When a company goes public, it divides its ownership into shares or stocks, which are then available for purchase by investors. Next is the cost capital. The cost capital of capital is composed of two main components. First, debt and equity. Debt represents borrowed funds such as loans or bonds that a company must repay with interest. While equity refers to the ownership interest in the company held by shareholders who expect a return on their investments. The cost of debt is typically calculated by considering the interest rate paid on loans or bonds issued by the company. The cost of debt is influenced by factors such as the credit worthiness of the company, prevailing interest rates, and the market's conditions. The cost of equity is, on the other hand, is more challenging to determine compared to the cost of debt. It reflects that return expected by shareholders for the risk they assume by investing in the company. Cost capital is a critical concept in financial management as it helps companies make investment decisions and evaluate the profitability of projects. At this point, the terms corporate securities, primary market, and secondary market need to define and discuss. So let's know first what is security. So security refers to income yielding paper traded on the stock exchange on secondary markets. So securities also are used by individuals, companies, and governments to raise capital or invest funds. There are two types of security. First is the fixed interest. Fixed interest, also known as fixed rate interest, refers to an interest rate that remains constant over a specified period. When you borrow money with a fixed interest loan, the interest rate remains unchanged throughout the loan's term. This means that your interest payments will remain the same, making it easier to budget and plan for repayment. While in variable interest, also known as adjustable interest or floating interest, refers to an interest rate that can change over time. Unlike sa fixed interest rates na remain constant, variable interest rates are commonly associated with loans such as adjustable rate mortgage or variable rate personal loans. With these loans, the interest is initially set at a fixed rate for a specified period. Next is the primary market. So, the primary market is where securities are created so they can be sold to investors for the first. Above all, the primary market issues new securities in exchange to allow companies, governments, and others to raise capital. So, diri siya magsugod tanan. The secondary market, on the other hand, is where previously issued financial instruments such as stocks, bonds, and derivatives are bought and sold by investors. So to understand furthermore, the primary market provides interaction between the company and the investor, while the secondary market is where investors buy and sell securities from other investors.
Hello everyone, I am Nikki Rivera, and I am going to tackle the securities offering in the capital market. A securities offering is a process whereby a company sells its securities to investors in order to raise capital. Securities can be either equity or debt. Ang equity securities, mao ni siya ang common stock o represent ownership in the company. Then, ang debt securities such as bonds represent loans that the company must repay. And there are two main types of securities offerings: public offerings and private offerings. In a public offering, the company securities are sold to the general public, while ang private offering is ang company securities are sold to a limited number of investors. Firms may obtain long-term capital funds through security offerings in the capital market. And there are two sources of capital funds: institutional and non-institutional. Institutional is, mao ni siya ang institutional investors is a financial intermediary that pulls money from individuals or corporations and invest it in a variety of securities, while ang non-institutional, it is a sources of capital refer to financial resources that originate from individuals, companies, or organizations that are not considered institutional investors. Next is, primary distribution may be achieved through any of the following. First, the investment bankers. Second, the private placement. Third, individual investors. The investment banker are financial professionals who advise corporations, governments, and other organizations on raising capital, mergers and acquisitions, and other strategic financial transactions. They also play a vital role in the financial markets by providing liquidity and price discovery. The investment banker is expected to perform the following functions. First, to investigate the corporation's financial conditions and needs. This means that this process involves a thorough examination of the company's financial performance, identifying potential areas of strength or weaknesses, and assessing its overall financial health. Second, to advise the corporation considering new issues of securities. This means that advising a corporation on new issues of securities involves a comprehensive assessment of the company's financial situation, strategic objectives, and capital needs. Third, to originate new issues. This means that originating new issues is the process of creating and bringing new debt or equity securities to the market. Fourth, to arrange for syndicate distribution. This means that arranging for a syndicate distribution is the process of selling a new issue of securities to a group of investment banks, also known as a syndicate. Fifth, to underwrite securities. This means that underwriting securities is the process of guaranteeing the sale of an issue of securities to investors. And six, to market securities. Investment bankers are sometimes referred to as an investment houses. This means that marketing securities is the process of promoting new existing securities to potential investors. Investment banks play a key role in marketing securities by issuing press releases, organizing roadshows, and conducting investor presentations. Next is private placement. Private placement refers to the sale of securities directly to a select group of investors, often institutional investors, rather than through a public offering. This method is commonly used by companies to raise capital without the need for a public offering. Providing a more targeted approach to investors, It's a way for businesses to access funding while avoiding the extensive regulatory requirements associated with a public offering. The third one is individual investors. Individual investors are private individuals who buy and sell financial assets for their personal investments portfolios. Unlike institutional investors such as mutual funds or pension funds, individual investors typically trade with their own money rather than managing funds on behalf of others. Underwriting and selling the firm's securities. The underwriting of securities may be done using any of the following methods. First, negotiated underwriting. Negotiated underwriting is a type of underwriting in which the underwriter and the issuer negotiate the terms of the deal directly without the involvement of a bidding process. Second, competitive underwriting. Competitive underwriting is similar to negotiated underwriting, except that the underwriting group bids against other underwriting groups for the initial purchase sa security. And third, commission sales. Commission sales is a type of investment banking transaction in which an investment bank acts as an intermediary between a client and a buyer or seller of a security. Fourth, direct sales. Direct sales is a type of investment banking transaction in which an investment bank sells securities directly to investors, and this is in contrast to commission sales where ang bangko nag-act as an intermediary between the client and sa tigpalit or seller sa security. Fifth is firm commitment basis. The firm commitment basis is an underwriting agreement wherein the investment house agreed to purchase the issue from the issuing corporation. So, ang firm commitment underwriting is type siya sa underwriting agreement in which the investment bank or underwriter guarantees to purchase the entire issue of securities being offered sa issuer. This means that the underwriter assumes all the risk of selling the securities to the public. In other words, if the underwriter is unable to sell all of the securities, it will have to purchase the unsold securities itself.
Good day everyone, this is Francis Carl Icot from BSB FM1A, and for today I will talk all about the securities market. So the securities market, it is the conduit for distribution of outstanding issues. So sa securities market kay diri mahitabo ang transaction of buying and selling sa mga stocks, bonds, and their derivatives sa usa ka company. So diri siya silbi marketplace nga palitanan sa mga stocks and bonds sa usa ka company. Two components of securities market. First is the auction type market. Auction type market is a market where goods or services are sold to the highest bidder. So diri kay ang ilang baligyan sa ilang stocks, bonds, derivatives, and sa mga shares sa usa ka company is katong kwartahan jud mamili sila mga mapalit nga katong dagko o kanang hatag or dagko ang ilang ibayad. Next is the negotiation type market. So, ang negotiation type market is a market where goods or services are sold through bargaining and reaching a mutually agreed upon price. So, ang kani siya kay pwede rin siya masabutan ninyo sa usa ka company kung pila ray limit sa imong makaya, kung unsa ray stocks nga imong palit or bonds na imong palit sa iyang company, or pwede ra sad og kanang through bargain if magkuha ka sa iyang stocks, pwede sa ka makakuha sa stocks sa iyaha. So, the most notable in terms of exchanges. First is the New York Stock Exchange, where it is known for its large stock exchange in terms of dollar trading. And next is the Philippine Stock Exchange, which is known for largest and oldest stock exchange and biggest in the Southeast Asia. And also there is London Stock Exchange. Ang London Stock Exchange kung ang Philippines is kanang on Southeast Asia, Russia, largest and oldest. Ang London Stock Exchange is worldwide siya nga kuan, so listed at the PSE or Philippine Stock Exchange are classified into 5 sectors. Namely, first, banks and financial services. Second is commercial and industrial. Third is property. Fourth is mining. And fifth is oil. So, counter market. So, over-the-counter market is a decentralized market where securities are traded directly between parties without the involvement of a centralized exchange. So, ang over-the-counter market sa tanan siyang market i-distribute or i-disseminate, wala sila specific na location or platform like across multiple departments, unlike sa centralized exchange kay single market ragyod siya, dili na siya mo kanang mobalhin paglain. There are middlemen of securities such as broker, dealer, salesman, and associated person of a broker or dealer. So, ang broker mao ni mopalit or mobaligya sa securities sa usa ka company, while ang dealer kay mao ni mopalit og mobaligya og sa securities with its own interest or para ra jud sa iyang kaugalingon. Then ang salesman, syempre mo sila mo negotiate sa lain company to buy their securities. And lastly, ang associated person of a broker kay mo ni right hand if busy ang broker, say mo puli sa kanang broker like kanang mopalit og stocks and sa lain company. Registrations of broker, dealer, salesman, and associated person is vital requirement in financial industry. This process ensures that individuals involved in buying, selling, and trading are qualified and adhere to the necessary regulations and maintain the integrity of the market. So, ang registration sa mga broker, dealer, salesman, o associated person is one of the important process for those individuals nga nagtrabaho sa stock market o investments. Kini nga process is ma-approve sa usa ka tawo nga mokuha og lisensya gikan sa Securities and Exchange Commission or SEC, so they can operate sa mga investment securities.
Hi, I am Cristal Marirama, and today we're going to talk about the Securities and Exchange Commission. What is Securities and Exchange Commission? The Securities and Exchange Commission, or SEC, is an independent federal government agency that oversees the securities industry in the United States. The SEC is responsible for protecting investors, maintaining fair and orderly markets, and facilitating capital information. The SEC was created in 1934 in response to the stock market crash of 1929. The SEC has a wide range of responsibilities including registering securities, regulating securities exchange, regulating brokers and dealers, and enforcing security. The SEC is an important part of the financial system, and it plays a vital role in protecting investors and maintaining a fair and orderly markets. Philippine Stock Exchange operates during 9:30 a.m. to 12 p.m. with a 10-minute extension and is open on weekdays, closed on legal holidays, and when BSP Clearing Office is closed. Their trading centers are at Pasig City and Makati City. Trading of shares shall be in term of fixed amount called board lots. Board lot is a minimum numbers of shares an investor can buy or sell at a specific price range. Therefore, it is a minimum amount of initial investment, and it will vary depending on the market price of the stock as well as its corresponding board lot. And trading in units lower than the minimum standard unit of trading or odd lot trading is also allowed. Odd lot is an order amount for a security that is less than the normal unit of trading for that particular asset. Odd lots are considered to be anything less than the standard 100 shares for stocks. The Securities Regulation Code, or SRC, is a comprehensive law that governs the issuance and trading of securities in the Philippines. The Section 2 of the SRC is a fundamental statement of the policy of the law. To summarize the Section 2 of the Securities Regulation Code, it sets out the objectives that the Securities and Exchange Commission must strive to achieve in regulating the security industry in the Philippines. By adhering to the principles of public interest, investor protection, fair and orderly markets, capital formation, and economic development, the SEC can help to ensure that the Philippine securities markets are a safe, efficient, and transparent source of capital for businesses and investors alike.
Again, I'm Kenji Pitugo, and to give an outline of Chapter 12, which is the securities market, securities market plays an important role in distribution of securities. Why? Because it serves as a conduit for buying and selling of outstanding issues of securities. When we say conduit, it is an entity or something na gina-set up sa mga banks to give financial sa mga companies or funding investment. Kaning securities market, dili pud nakuha ang mga buying and selling of securities. When we say securities sa mga finance, it include mga stocks, mga bonds, or derivatives. Sa securities market consists of two ni siya, which is the auction type market o negotiation type market. Sa auction type of market, diri nakuha ng international o national stock exchanges. Like ang buyers ug sellers diri kay mag-compete, like magbidding sila, like padak-anay sila presyo kung kinsa makakuha to nga securities. While sa negotiation type market, diri na musod ang over the counter market or the OTC or the off board. Diri kay ang kanang ang transaction diri kay directly between dealers na provided na ni sa mga dealers katong willing na or ready na mo palit or ibaligya ang ilang particular securities at certain prices. And then, kasagaran sa transaction sa OTC kay, kuha na siya, email, telephone or telegraph or other forms of communication. Ang difference sa trading in the exchanges o OTC kay is that ang trading exchange na kay open sa public, while the OTC kay dili siya open sa public, like between dealers na siya. Sa securities market, nasa tayo stock exchange diri. Di ba ang OTC, negotiation type market? So, ang stock exchange, auction type market ni siya, where the securities bought and sold. So, kasagaran ni siya mahitabo or makitaan sa mga capital cities around the world. Ang notable nga example ani kay ang NYSE or the New York Stock Exchange. So, kaning NYSE, mao na ang pinakadako nga kanang stock exchange in terms of US dollar value traded according to Wikipedia 2005. Sa securities market natin ginatawag nga middleman. Under the Securities Regulation Code Republic Act number 8799. Ang middleman consists of dealers, brokers, salesmen, and associated person of a broker and dealer. And they are required by the law to be registered. And ang prices daw sa stock and volume of trading kay magdepende sa day to day. Kay mag-agad man pud na sila sa mga demand o supply. And then sa trading in the Philippine Stock Exchange kay is undertaken daily except lang sa Saturday, Sundays o holidays. And then ang method of transaction nga ilang gamiton diri kay double auction market between buyers and sellers who are represented by the brokers.
Hi everyone, I am Hazel May Amlaran from Group 1 and I'm going to tackle the Chapter 3, which is the leasing. A brief description of 3 leasing companies. Lease defined, type of leases, and the basic lease provisions. So, leasing as an important source of financing has been recognized already for some time in the Philippines. So, ang leasing kun kay popular source of financing sa atong nasod, which is the Philippines, sa dugay na nga panahon and up until now. Let's proceed to the brief description of 3 leasing companies. The first one is the Food Credit. Food Credit is the largest company in the world dedicated to automotive finance, serving more than 10 million customers in 40 countries. So in 2001, Food Credit financed the sale or lease of more than 5 million new and used vehicles around the world. Food Credit is a division of Primus Finance and Leasing Incorporation, which currently operating in the Philippines with a staff of 40 people. So, the Food Credit kay mao ni siya ang pinakadako or leading automotive finance company in the world. So, the Food Credit serves over 10 million customers in 40 countries. In 2001, ang Food Credit kay nag-sale or namaligya o more than 5 million new and used nga mga vehicles around the world. The Food Credit also a division of Primus Finance and Leasing Incorporation, which means that the Food Credit kuno is operate within our country with a staff of 40 people. So that is why the Food Credit is the largest automotive finance company in the world. So another leasing company is the PCI Leasing and Finance Incorporation. This is an 84% owned subsidiary of Equitable PCI Bank. Its principal business is to provide leasing and finance products to commercial clients. As of December 31, 2003, the company's leasing and financial products contributed 40% and 56% to its gross revenues, respectively. So, ang PCI Leasing and Finance Incorporation is a subsidiary of Equitable PCI Bank that provides leasing and financing products to commercial clients. So, ang kanilang company kay has leasing products contributed 40% and financing products contributed 56% to the company's gross December 31, 2003. So, the third leasing company is the Japan PNB Leasing and Finance Corporation. This company is a joint venture between the PNB and the IBG Leasing Corporation, Japan of the Mizuho Financial Group. The company started operations in the Philippines in 1998 and has assets of more than 1 billion pesos. So, ang Japan PNB Company Leasing and Finance Corporation is a joint venture between the Philippine National Bank or PNB and the IBG Leasing Corporation, Japan of the Mizuho Financial Group. So, the Japan PNB Company was established and assets over 1 billion pesos. So, lease defined as a negotiated contract between the owner, which is the lessor, of the property allowing the firm, which is the lease, the use of that property for a specific period of time for a specific rental. The lessee is the party that uses rather than the one who owns the leased property. Ang lease kuno is the arrangement nga nag-include ang mga contract between the owner of the property, which is the lessor, and the person who wants to use it, which is the lessee. The lessee kay mubayad siya og rent sa lessor in exchange for the right nga gamiton ang property for a specific period of time. So let's proceed to the type of leases. Leases may be classified into 4 general categories. The first one is the financial lease. Financial lease is a non-cancelable document that obligates the lessee to provide periodic rental payments during the basic lease term. So, sa akong gingon, ang financial lease kay usa siya ka non-cancelable document. So, once ang financial lease kinapirmahan na, it cannot be cancelled. Kani siya kay ang lessee is obligated nga mohatag og regular payments to leasing companies for the use of the assets. So, let's proceed to the second type of lease, which is the operational lease. So, operational lease is also called as a service lease. This kind of lease that usually cancelable by the lease with a proper notice, and the lessor usually maintains the asset. So, kung ang financial lease kay not cancelable, ang operational lease kay cancelable by the lease nga naay proper notice. So, in the operational lease, kay the lessor is responsible for maintaining the assets. And lastly, the operational lease kay short duration na siya kaysa sa financial lease. So, the third type of lease is the sales and leaseback arrangement. So, it is a special type of lease when a firm owns an asset, sell it to another, then uses the same assets on lease agreement with the owner. So kani siya kay is a transaction of a company that sells its assets to another company and then leases nga naay assets kay mobalik ra siya from the buyer in a specific period of time. Kani siya nga type of lease kay gitawag siya og investment. And the last type of lease is the net and gross lease. So leases can be either net or gross. Under the net lease agreement, the leasing bears the expenses associated with the assets such as taxes, repairs, maintenance, and insurance. These expenses are borne by the lessor in a gross lease. So in a net lease, the lease is responsible for paying some or all of the properties of operating expenses such as mga taxes, insurance, maintenance, and also the repairs. So these expenses kuno kay are borne by the lessor in a gross lease. So we are now in the basic lease provision. This a typical lease agreement contains some or all of the following provisions. So the period over which asset is to be leased. Lease periods may vary from 1 day for a rental lease to several hundred years for a property lease. Term it is a duration of lease which can range from short-term rental to a long-term property lease. The rental payments and then payments date. Payments may be monthly, quarterly, semi-annually, or to any interval that the parties may agree upon. Siya kay the amount of rent to be paid and the schedule for payment, which can be monthly, quarterly, semi-annually, or according to the agreement upon terms. This is the assignment of responsibility to one of the parties, such as associated costs as taxes and maintenance. So, kani siya kay determines which party, the lessor or the lease, is responsible for specific costs associated with the assets, such as maintenance, insurance, and the utilities. Next is the security provisions like prohibitions against the lease, incurring additional debt, paying dividends, or acquiring common stock. So, protects the lessor's interest by imposing restrictions on the lease action such as limitations on acquiring additional debt, paying dividends, or reacquiring common stock. So, escalation clause allowing the lessor to raise the periodic rental payments that some predetermined dates over the life of the lease or in response to increase the cost. So this one allows the lessor to increase the rental payments at predetermined intervals or in response to raising cost. The last one is the options allowing the lessee to renew the lease or purchase the asset. So this one is it provides the lessee with the opportunity to renew the lease agreement or purchase the asset at the end of the lease term.
Advantage of leasing. So before we continue, what is leasing again? So leasing is the process of renting a property or using an asset for a specified period of time in exchange of regular payments. So mo ni ang business nga have temporary access to asset without a need of full ownership. So the first advantage of leasing is lessor bears ownership risk. So this is a person or entity or the owner of the property or what we call the lessor is responsible for any potential risks or issues that may arise during lease period. So ikaw nga igor sa as a lease or igor sa ni rent sa property dili nimo obligation ang maintenance costs, repairs, insurance or any liabilities associated with the property. So the second one is flexibility. So it allows greater flexibility in terms of lease duration, payment terms, or any other provisions. So ang landlord or the tenant or the owner of the property have the ability to negotiate or adjust certain aspect to lease and to better suit their needs. So unlike sa traditional fixed term, you have a rental agreement. So the third one is piecemeal. So it is a method obtaining funding or financing for a project or venture in a small increments or stages. So when we say piecemeal, step by step din na siya. So to achieve a different stages or components of project that are achieved. So the fourth one is avoidance of restrictions accompanying debt. So it is the bond issues at times that restrict the borrower from acts of further borrowing. So if the firm needs additional fund to finance its operations, but it has no choice but to wait until the bond issues are redeemed. So the next one is evasion of budgetary restrictions. So this is an act intentionally finding ways to bypass or avoid limitations and constraints set by the budget. So it can be done through misreporting expenses, hiding income, or engaging in unauthorized spending. Next is cash mode available for profitable investment. So this is a capital accessible and can be allocated towards investment and have the potential to generate higher in return. So it offers opportunities that generate higher profitability in terms of seeking out investment. So next is tax advantages over ownership. So it is benefits or advantages that individuals or businesses may receive when they choose to lease or rent an asset or properties instead of owning them outright. So as a lease, you have the right to transfer the tax obligations to the lessor because they will be the one to manage it. So the last advantage of leasing is lease does not appear as a debt. So it is a leasing arrangement where lease asset or property is not considered a liability or debt on lease's financial statement. So let's proceed with the disadvantage of leasing. First, it is more costly than if the firm purchased the asset. So the next one is benefits of depreciation, investment, and tax credits and salvage value are not availed of by the lease. So lastly, when the lease does not avail of these benefits, so it means that they did have the access of these advantages associated with depreciation deduction. When lease financing may be utilized, so there must be a cost savings over borrowing. It must be available where an equivalent of amount of debt financing is not available. Some offsetting advantage, which in the opinion of management justifies its high cost. So lease financing must not be utilized without considering other alternatives, and it must be used only when it is financially defensible. Lease is very crucial in terms of long-term financing, and lease is negotiated contract between the owner of the property, or what we call the lessor, allowing the firm to use the property, or what we call the lease, so for a specific period of time and a specific rental as well.
Thank you for watching.